we're going to have a really nice and interesting panel with industry leaders from the TradFi space, from the trading space, both in crypto, but also in the traditional finance instruments. And the topic of today's panel will be the adoption of digital assets. Firstly, I would like our speakers to introduce themselves, tell the audience how they entered the crypto space from the traditional finance, and a little bit of background about who they are and what they do.
Hi everyone, I'm Sebastian Widmann. I'm the head of strategy at Komainu. Komainu is a regulated digital asset custody provider, and it was launched as a joint venture between the Japanese investment bank Nomura, CoinShares, a leading fund manager in the space, as well as Ledger, a French technology provider. We launched Komainu in 2018. It was spun out of Nomura, the traditional investment bank. So that was my mix from traditional finance into digital asset finance. And since then, we've grown significantly. We're around 50 people. We're regulated in a number of jurisdictions, including here in Dubai under VARA. We have offices in Singapore, Jersey, London, and across the globe as well. And we tailor purely to an institutional audience.
Cool. Very good afternoon. My name is CJ. I'm from GSR Markets. We're the largest altcoin market maker in the space since 2013. I run the sales team for Asia and Europe, covering the Middle East as well. Got into crypto in 2017, and my background, as Faraj mentioned, is from traditional finance. I spent more than 10 years on the trading floor at Morgan Stanley and Nomura up in Hong Kong. Thanks for having me here.
Hello everybody, my name is Marc. As you can see, I never thought this selfie would ever be on the screen like that. Sorry about that. I work at IMC. IMC is a big market maker in traditional finance. I started there like 30 years ago, almost. I left in 2010, and then I started my own little crypto trading firm in 2016. That was bought by IMC in 21, and that was the start of IMC Crypto. My role now is business development and mainly for token market making.
Good afternoon, everyone. My name is Frank van Zegveld. I'm the head of sales in EMEA for Talos. Talos is an institutional technology provider who cater, let's say, the complete ecosystem in digital assets. We provide infrastructure, trading technology, and connect, let's say, all the players globally with a team of 120 people. My background is also in TradFi on the FX side, both on technology and trading.
Excellent. So let's start with the adoption. And where do you think we are now with institutional adoption of digital assets currently?
So we've always been waiting for the institutional adoption of digital assets as a whole. We, as mentioned, tailor purely to institutions in the space. To date, to be honest, it's mainly crypto natives players. We're working with a wide range of clients. So there's the main hedge funds that have started positions in digital assets. Some of our investors, including is Alan Howard with Brevin Howard, who notably launched Brevin Howard Digital, focused on digital asset spectrum. There's a wide range of hedge funds, I think, that are now starting to move from the traditional markets into digital asset markets. We're also seeing a lot of interest from traditional banks that are looking for custodial solutions. We think that custody is one of the foundational pillars of anyone's digital asset strategy. And so we're really trying to be the most regulated and reputable custodian to really facilitate additional adoption from more regulated traditional institutions to come into this marketplace.
I think when we talk about institutional adoption, you've got to bifurcate it into the tech that is blockchain and the concept of a capital market investment. I think on the tech side, we are seeing more and more. Project Guardian out in Asia is proof of that tech coming through. JP Morgan's been involved in a couple of internal private blockchains as well. And there are players who are looking at the technology as something that they can use for their business. On the capital market side, I think we haven't seen what we thought we would see back in 2021. And that is a whole wave of institutions coming in to literally buy Bitcoin, buy Ethereum, and store it. However, what's happened since then is a lot of infrastructure and pipings have been put in place. Guys like Komainu coming up, for instance, to be able to help these institutions store such products. I think with the dawn of the ETF, it is definitely going to open up the gates. Maybe not a flood, but it will definitely continue to pique interest in the space as well.
I am a good example, I guess, because IMC is an international player in the crypto field. I think the appetite is there, clearly with us. It's just that there are, well, all the hurdles and the lack of trust sometimes with exchanges that everybody knows and that everybody's been talking about today. When I had my own little trading firm, crypto trading firm, we could do anything. And now at IMC, things go a lot slower. There's risk, there's legal, there's compliance, a lot of projects we can't touch, a lot of exchanges we can't trade on, and things go slowly. So when we wanted to trade on a DEX, for instance, somebody came to me and said, so how much money do you think you're going to make there in 5 years? I said, well, this platform has existed for 3 weeks. I hope it's going to be there in 3 months. But this is not how crypto works. But it does show how these institutions think. So it's long, and everything is long term, and it's so once they are committed, once they're in, and that is, I think, a very good thing.
Yeah, a bit echoing maybe what my other panel members telling here, but I think it's still early days. But institutions have arrived, but also conscious of the fact that after the FTX and all the other events, what happened, and be very cautious to jump in this industry. And I feel like that and again, maybe drop the elephant in the room here, when it comes to regulation, when it's becoming more clear how institutions can interact with each other on a safe way, we see more and more adoption coming fairly soon.
Thanks a lot for that. Coming back to FTX, I think every one of us in this room knows what has happened. What was the impact on the institutions and their approach towards the crypto assets in general after that incident?
I think an interesting example is really custody in the space. So prior to FTX, a lot of players we spoke to came to us and said, why do we need a custodian in the first place if we have to move assets from the custodian to the exchange to be able to trade on there? If we can use a player like FTX in the first place, have our assets on the exchange, and then just trade them there instantly. I think we've all seen what happens, and a lot of our new clients now learned their lessons through the FTX bankruptcy. I think overall, it really will be a long-term benefit to the industry as a whole, given that it is pushing for maturity, is pushing for change on the regulatory angles, is pushing also for change at the infrastructural level. So one thing that we've been working on for over a year now, and we're really gaining traction, is off-exchange trading. So we're now allowing our clients, and we've announced today with OKX and CoinShares, that you can trade spot as well as derivatives products on exchanges whilst having the assets in a regulated third-party trusted custodian like ourselves. So we see some of these developments more mirroring traditional financial infrastructure and bringing that level of maturity and regulation into digital assets is really one of the impacts, I would say, of FTX that will over time really benefit the industry as a whole.
I mean, just to start it off right, FTX was not a failure of blockchain, and it was not a failure of crypto. FTX was a failure of humans, and it was a failure of TradFi guys who had been doing the same thing since the days of Bear Stearns before that, and they're just reproducing the same effect. I think the biggest problem we saw with the FTX thing, and I agree with what Sebastian said, there's been a lot of growth since then when people realized that you need certain pillars of infrastructure to be put in place. But the biggest thing on the negative side that affected the business as a whole on the street was a lot of the upcoming tier 2, tier 3, tier 4 funds in the trading space got burned very, very badly. And these are the funds that we need if we're going to grow liquidity, volumes, and interest in the space. It's not about the VCs, it's about the funds who mimic hedge funds in the traditional finance space coming into crypto to trade. But a lot of these guys had assets locked on FTX, and part of the reason is because FTX was a leader in the space when it came to cross-margining, collateralization, and efficiency of trading for institutions. So that confidence needs to be rebuilt again, and a lot of these wounds need to be healed.
Yeah, so I was at the Digital Assets Summit in London 2 days after FTX happened, after Monday, which was in November, maybe exactly a year ago. People were in shock, and I think the institutional, the banks and everything that were there were like shooed away for at least another 6 months. And now it is true that a lot has happened for the better. So this is, yeah, well, we need supervision, right? So that is clear. Everybody knows that now. There has been a few big reality checks, so I'm pretty confident that that will not happen again. So we are slowly, with lots of hiccups, but we are moving forward and getting somewhere that it's going to be a trustworthy place again.
Yeah, events like that, I mean, also gives another view from a risk perspective, and I think there's more and more need for risk management tools as well, which is the outcome. So coming from the question, okay, what did the market notice, let's say, after the FTX? Yes, there was slowdown on the players. You see shifts, let's say, where the liquidity was coming from and redirected in different places. But I think the risk awareness on the participants in this space has massively increased and will only increase until, let's say, regulation becoming more and more clear.
Excellent. Coming back to the theme of our topic, the adoption of digital assets, what institutionals understand by word adoption? Is it about investment? Is it about potential of the blockchain technology? Is it about the adoption by the retail users or Web2 users? Like, what adoption really mean?
So I think adoption is exposure to the asset class as a whole. So obviously that can take many forms. It can take investments directionally by buying tokens, Bitcoin, etc. It can be venture investments, and I think most institutions are already to some extent exposed through their venture arms or venture portfolios to companies that are indirectly or directly as well exposed to digital assets themselves. And then I think, to what CJ mentioned earlier, is really the type of assets you're working with. I think any global financial institutions already dealing with tokenized securities, looking at stablecoins, looking at the potential of central bank digital currency. So everyone has a strategy. It's just a matter of how far along their journey they are in terms of executing on that strategy. I think digital assets, which is still a sub 2 trillion asset class as a whole, is more risky, and so the risk reward for a global custodian or a global bank to really go into the market is not yet there, whereas for the risk reward for a global custodian to get exposure to tokenized securities, stablecoins, has to be there already. So we're seeing a lot of innovation, and I think there's a lot of hype again around real-world assets on a blockchain, which, looking back in 2017, is one of the reasons we launched Komainu, and we've always referred to digital assets rather than crypto itself, to really not limit our scopes and further attract and enable institutions to deal with any digital assets, whether that's a stablecoin, a tokenized security, or a crypto token.
I think, I'll go back to the original comment, right? Adoption in the tech side of it is pretty straightforward. It's the lowest hanging fruit. What it brings about with this technology is efficiency and trust in technically trustless transactions. I think from a capital markets perspective, I think we shouldn't kid ourselves. I think expecting the largest insurance companies in the world to buy a coin that is ranked top 250, bit far-reaching. But seeing a world where some of the larger institutions allocate a percentage of their investments to the basics of Bitcoin and Ethereum, I don't think is that far out. But the question is, will they do it via the methodology of deliverable Bitcoin, or will they just hold on to the ETF? And I think that's what we're going to see, that split where institutions will play in one field and the rest of crypto and the retail market will play in another field. And there will be instances where they cross, where they connect, but at the end of the day, that type of adoption we will probably see.
Okay, well, I can only speak about trading. I do see the competitors we have in traditional finance entering the space, which is good for us. I mean, we like it when there are more market makers. It's good for the markets because they become more professional. Crypto at IMC will always be much smaller than the traditional business. and it's still considered a bit risky. So the head of legal worries about two things: regulation and reputation. So we can never do anything that would jeopardize a trading license we hold somewhere, and we can never do anything that would jeopardize the good name we have. So these are the boundaries that are totally normal, of course. And luckily crypto is moving in, and also crypto exchanges are moving in a direction that we are safe and happy to be active.
Yeah, when it comes to adoption, I think there are also interesting to what you mean, let's say, and you speak to different participants in this space, right? For hedge funds, it might be more trading. For pension funds, it might be more on the investing side. And for banks, it's more like participation in this field for serving their customers on custodian services and stuff like that. So adoption is not a common element and depends on who you're speaking to and to what extent they want to participate in this space.
Yeah, thanks for your answers. And how do you define institutions? Because there are like lots of different types of institutions, like hedge funds, high net worth individuals. What's their risk tolerance towards like crypto? And do you see that some of those institutions, like family offices, are bringing the trading in-house versus relying on external partners? What trends do you see there, and what kind of institutions are active currently in crypto space?
I think a wide range of institutions are already active to some extent. A good example is my former employer Nomura officially spun out a subsidiary, 100% owned by the firm, called Laser Digital, and I think their head of sales earlier was speaking at one of the panels. I think that's the prime example of a large traditional global financial service institution that has over 100 years of experience in traditional markets, really moving the way and getting exposed to the asset class as a whole. I think everyone's looking at ways to doing it. I think, as we've mentioned on the panel already, different regulatory regimes across the globe facilitate or block some of these adoption and the speed of adoption. But I think there's a clear drive of major institutions to really gain exposures, either directly or also indirectly through partners that they trust in the industry.
Categorizing the institutions and what they're doing in the space, it's very much down to push-pull dynamics. Private banks, for instance, the fact of the matter is there are a lot of high net worth clients who have taken an interest in this space. And not so much from the tech thing, but a lot of them from as an investable asset class. So a lot of them, yes, they're being pushed by their clients to say, what can you offer in this? And so I think that's one direction they're heading. I think within the banks themselves, some of the trading desks have now been repurposed to look at, is there alpha? Can I make money trading this? And you sort of see these banks appear on the CME, crossing. That tends to be a case there. Hedge funds is an interesting one. I think Marc's probably closer to the ground that one. But what we've heard out in Asia is a lot of the hedge funds have taken a step back and have been putting in place infrastructure and piping, but they're not actively trading it yet. And I think more to Frank's point from earlier on, I think we're going to see require more regulatory clarity before the tap is properly turned on in this space.
Yeah, I think that's right. Oh, sorry, Marc. I hear what CJ is saying. I think banks, for example, are gearing up. You see that now more and more in EMEA, with MiCA regulation coming in play fairly soon. So RFPs and RFIs are being issued so that they at least be geared up when they want to jump into that space. I think the smaller family offices are already active by doing that via maybe a broker or any indirect, let's say, interaction with the market. Yeah, so it's just waiting for more regulatory clarity, and I think then the institution will pick up.
Yeah, and what are the barriers that are existing that holding the institutional back in terms of getting like more adoption towards the crypto assets?
I think there's two main ones. On one side, there's regulation, and I think we're seeing global regulators really starting to race to create clarity in this ecosystem for digital assets, for stablecoin, for tokenized securities. I think the region here, the United Arab Emirates, with its different emirates, is proactive in a sense. I think over the past year, they've done a very good job in creating regulatory clarity, and I think we're seeing it with the ecosystem really growing at a fast speed, I think one of the fastest globally. You also see other regulatory regimes, including Hong Kong, that did U-turns and now is again becoming very proactive, or the US, which still to some extent is the largest market, but really did a U-turn and is now enforcing or launching enforcement actions against a lot of the players operational there. So I think to some extent, given that this is a global asset class and most real institutions operate at a global scale, you'll need to see harmonization or global regulatory standards and clarity to evolve. And I think the second area is what that then enables is regulated and reputable market infrastructure that is also required for institutions to not have to set up everything in-house, but then to be able to rely on custodial partners, liquidity partners, exchange partners, etc., that they can resonate and are more akin to what they're accustomed to in traditional markets.
Besides what Sebastian just said, the most important thing is going to be trust. And the problem is that the institutions, if you think about it, are right now standing around the playpen, watching all of us inside it play around and try and grow this product. And the more we see instances of fraud, the more we see instances of rug pull, bad actors in the space, permeating the space, it's going to take longer than we initially thought. And I think we thought that a lot of it was flushed when FTX occurred, and followed by Three Arrows, followed by Celsius, etc. But it hasn't. There are still plenty of bad actors. Once these are removed from the ecosystem, then you can, so to speak, create an environment where institution guys, as Marc has alluded to, can clear it with their legal, can clear it with their compliance, to trade inside and saying, I'm not going to suffer reg risk and I'm not going to suffer reputational risk. So that element needs to be there.
Well, I guess what everybody's saying is the regulation is the biggest hurdle. That's clear. I mean, a good example is IMC never did business with companies that had a Cayman entity. Now we have our own Cayman entity for certain crypto trades, so we had to get rid of that rule because well, we have 3 different entities trading crypto just to be able to do what we want to do. And that's not very capital efficient. It's also hard to explain. It's just ugly, and that is a big blocker. In Europe, you get MiCA like a year from now, which is good. It's going to block exchanges from having their own market maker, which is just really not good practice. And so again, we're getting there, but it's there's still a few things. I can imagine that there's still hurdles that people. Make sure they don't trade crypto yet.
Yeah, besides trust and regulatory clarity, I think that investors in digital asset space also looking for tools to manage their risk and the ability to interact with the market safely. And I think the lack of tools or on an institutional level, which is being built by companies like ourselves and some others out there as well, I feel like when that comes more in play and we have the ability to execute on, I would say, almost a risk-free kind of element, that will help to the adoption as well and will remove some of the barriers and interaction in the market.
And let's focus on regulation a little bit. I mean, what's your view on the regulator landscape overall, its development, and is it fast enough to actually catch up with the pace at which industry develops and at which the adoption is going, or it's actually slowing down the entire process?
Regulation is never fast. I also don't think it has to be too fast, given that it needs to be robust yet flexible. Our perspective, we're regulated in a number of jurisdictions. So we're regulated as a fund service business in Jersey since 2019. We have a UK VASP registration with the FCA. We're registered in Italy under OAM. We have a custodial and custodial staking license here in Vara. In Dubai, we're also looking at a number of other regulators. So we're in continuous dialogue with the MES, with the GFSA, with global regulators to really understand what's their thinking, how's the ecosystem evolving, how are the rules shaping up. I think we're always pushing for regulatory clarity. We're helping regulators get educated as well at some point. But I think it's really a global game. Some regulators are faster than others. Some are more crypto niche, whereby they regulate activities rather than the asset class as a whole. So I think there's no perfect solution. I think everyone's trying to really make a push, and I think the industry as well is calling for more regulation, more clarity. So it's a journey rather than a sprint, I would say.
Yeah, I just want to echo. Regulation can't be too fast or too slow. It has to move in line with what makes sense in the market. I think if our expectations is to create the right set of rules for institutions to be comfortable to come play in, it will happen. And I think one thing that we are seeing is regulators are moving at varying speeds. In Asia, for instance, Hong Kong and Singapore have led the way. Japan is coming into the foray right now, so is Korea with retail regulations. The Middle East is catching up, Europe is catching up. The US has done a pivot and they'll probably come back to it. So I kind of feel like it's for them to figure out who will lead the way. But I still believe that pace of regulatory change is not affecting the growth of crypto as a marketplace or the inventiveness that we're seeing. It's more to put in place the right infra so that larger institutions can feel comfortable to come in.
I totally agree. I would like to add one interesting thing is that I was at a consensus, and there was the guy from a young, very smart guy from the Bank of Japan, and he said if we stop the clock now and regulate everything, then we know a year from now it's not good enough anymore. So we also need to stay flexible because things are developing so quickly. So I think that is a valid point as well.
Nothing to add to that. I think what we do see is that APAC and EMEA in general are a bit more in line now with regulatory frameworks, and you see there are more people moving towards in that directions for starting their crypto business. US, of course, is pretty strict at the moment and a very bad spot to be in. And that's what I see predominantly in EMEA, where even US entities starting a license in Europe and start a business from there.
Thanks for that. And there is a general theme about real-world assets and tokenization ongoing. So how do you think is it going to be the future of the next cycle? Like that's going to be the next big thing. And what do we actually miss for the successful tokenization of real-world assets?
So I definitely think it's part of the picture. Again, just to my analogy earlier, the risk reward for a global custodian to not engage with digital assets is not too high. The risk reward for a global custodian to not engage with digital securities, which is 100% of their existing business, is too high to miss. So we're seeing a lot of innovation and drive being pushed there. I think there's a lot of projects really driving for innovation, driving for standards, and driving for regulation as well. What's missing in the space, and I think one of the key components for real-world asset tokenization is to have counterparty risk-free regulated cash on ledger, whether that's a regulated stablecoin or it's a regulated central bank digital currency that really facilitates and solves for the on-ramp leg. It's hard to only have one leg of the transaction in the on-chain, so to say, if the rest is still relying on the more traditional, archaic financial infrastructure.
So tokenization of real-world assets is probably the hottest topic right now in both Hong Kong and Singapore. The governments are focused on it. They see a genuine use case, and for good reason, right? What tokenizations of RWAs does at the core and the crux of it is it offers liquidity. It offers liquidity to technically illiquid-based assets. However, I think there have been some junctures where people have tried to do things like tokenize bonds, tokenize stocks. That doesn't really make sense. Those are naturally liquid assets, and they're put in place by regulatory in terms of accredited investors and professionals. I think for RWA, what needs to happen, though, is a proper sizing of the marketplace in terms of what are we trying to tokenize and to what end. And I think the reason why, let's use an example here. If, for instance, someone tries to tokenize the Burj Khalifa, would you get an investor in Singapore saying, I want to buy that token? It's very unlikely. And the reason why he has no vested interest in owning that token, there's nothing in it for him. It'll be a very domestic market within the UAE region, for instance. That's one of the problems that needs to be overcome. The other thing that needs to be overcome, obviously, is the regulatory aspect of something like this. The easiest way for a lot of people to say is you regulate it like a security. But I think when you do that, you are cutting off a very large part of the market. And I think that's something that regulators have to come to grips with as well.
Yeah, the rise of tokenization and the topics, the panels every single week only on that topic itself. I think in general, all assets, or at least most assets, will trade on the digital rails eventually. And to what extent, and if it's a real-world asset underneath, or if it's just whatever coin it might be, we will figure out what will come next in the next couple of years.
Excellent. And going back to like mass adoption, like anyone knows that ChatGPT was the big thing for AI. Like it brought it towards like everyday mom and pop, and kids, knowing that what AI is through ChatGPT and OpenAI. What do you think gonna be the next moment in the crypto and digital asset history in this form? Is it gonna be another social media with Web3? Is it gonna be something else?
I think mass adoption, again, is not very relevant to the topic. I don't think mass adoption will ever be driven by institutions, especially in digital assets. Retail is the early mover, institutions follow. I think a big gap in the ecosystem is still user-friendly experiences. So the UX of most crypto applications is not there to facilitate mass adoption. I think there's a lot of interesting projects working towards. So I think easy access, on-ramping, and user-friendliness is the key current hurdle for most non-technical users in the space.
I think when it comes to mass adoption, we need to stop thinking about bringing 1 billion Web2 users into Web3. I think that's the wrong approach. And the reason why is, as humans, we are genuinely lazy. So by being lazy, what we should focus on in Web3 is how do we bring the tech that we have, blend it with what exists currently in Web2, so people can go about their daily lives pressing the same button every day, but the back end of the engine works differently. And I think that's where we're going to see that sort of adoption. On the other side, when it comes to adoption as well, I think from a tech aspect, one of the exciting ones, at least that's going to cause, I think, a leg up in terms of growth and evolution is what we're seeing in the roll-up ecosystem right now. That ability to process large amounts of data, reduce the transaction costs, that moves us in that direction of scalability and cost. I mean, it's part of the triangle and what we're trying to achieve here. So I'm very excited seeing a lot of these roll-up protocols coming up. ZK Sync led the way, obviously, but Scroll just went live. Polygon have their own. In Asia, you've got Tyco about to go live as well. So I'm quite bullish on what we expect to see in the next 6 months in that space.
That's interesting. So I think our panel is coming to an end. So I would like you to actually have some final words, maybe some success story for our audience about the adoption and institutions, and maybe deliver some message. What do you think is important and what they should take it as an insight from this panel?
So maybe personal analogy. In 2015, I published a number of papers, and the title was, even before blockchain, was the challenges limiting the widespread adoption of distributed ledger technologies. I did a survey with over 500 people who were thought leaders back then in the space, and it was a fairly small ecosystem. And the three main challenges were education, which I think to date, looking at 2023, is still the main challenge. The second one was scalability. I think whilst we're moving to the right direction, there's still huge gaps in that form. And the third one was, even back then, regulation. So I think we're still moving. Those, I would say, if I redid the survey, it would still be the same results, but we're definitely moving in the right direction.
No comments from my side. I think it's pretty much the same.
No story?
Got too many stories to begin right now, mate.
Okay. Well, I have one story to share, which was that I was at Token 2049 in Singapore last month. And that was on a Wednesday and a Thursday. And there were a few guys from TradFi, from the DCP team, for an equity options conference on Monday, Tuesday, Wednesday. I said, well, just stay one more day and visit us. We had a booth there and everything. At the end of that Thursday, they said, where can we sign up? This is so exciting. And that is, especially compared to the TradFi conferences, I mean, it has to. We talk way too much about regulation and all stuff like that. But there's still so many great ideas and so much interesting stuff happening that it has to we also have to talk about those things.
Still, smart and clear regulation will help the industry. it's not where it's built for, but I think that will, let's say, give the big buzz and make the market move. But let's aim for that, and the clarity will help us all in this industry.
Excellent. Thanks a lot for your time, and thanks for the great panel. Thank you very much.